Hey everybody, it's Clayton again. I'm just making a new video. As you can see, the value of my stocks have gone down because my gains have decreased. As I said from the beginning, that means very little to me. It's a dividend stock. I don't really care much as the stocks fluctuate up and down. They don't play much on my dividend. Now, if the dividends start to get cut, that's when we have a problem. And that's when I will likely sell some of these dividend or some of these stocks because I don't like to hold on to them as they cut dividends because that usually means there's a bigger problem coming down the pipe. Because usually companies won't cut that because when they cut a dividend, they know that they're going to have a lot of blowback and pushback from their investors. You can see if you look at my portfolio right now, it may look as if, and you can see it says 1 buy, 5 sells. I'm not actually buying or selling anything currently. Unfortunately, M1 Finance, there is one thing that I've kind of not been a huge fan of, and it has to do with moving stocks into pie charts. When I first created M1 Finance, I wasn't all that familiar with it, and I've gotten a lot better grip on it. And you can't just simply move a stock. So what you have to do is sell it for the exact amount it is valued at, then go into the pie and buy it for the exact same value. The problem is what I had to do, and I'll go into it in a much later video once it's all processed, but I had to contact M1 Finance because you need them to work with you to do this. It's not something you can really do on your end without risking a possible transaction or a trade. So I did have to contact them. I'll go into way more detail about this once it all is processed. I'll show you it being completed. I'll show you what it looked like before, what had to be done, the communication I had, and all that. But the main purpose of this video was I was looking to get into one or two other industries because currently now I've got bonds, I've got real estate, I've got technology, industrial, and commercial with what I've got listed. But I've been looking recently and there has been a bank that has really stood out to me. And I know that sounds weird because especially from the last crash, banks were the biggest ones that took the largest hit. But the one that really jumped out to me is Wells Fargo. And excuse me, back in September of last year, they hired a new CEO called Charlie Scharf. And let me pull up the article for you. This is on Simply Safe Dividends. You can see Wells Fargo finally appointed a new CEO to lead the bank following a 6-month search. He took over the job. It was October 21st. I apologize, not September. It was announced in September. He started on October 21st. But as you can see, before taking the job, he was the CEO at the Bank of New York Mellon, a firm that Warren Buffett basically had a lot of ownership in. And then he upped that stake between 17 and 18, which is when Scharf was there. Scharf was only there for, I think it was a year and a half, if I'm not mistaken. And the biggest thing the Wall Street Journal notes is how good he is and his experience with turnarounds. And to me, when Warren Buffett backs somebody, especially when it comes to the stock market, it's something that gets my attention. Now, when I first read this article a few months ago, I looked into it and I was kind of seeing if I wanted to invest and wanted to watch the stocks. And as anyone knows that's following, Wells Fargo has kind of been going up and down. Yes, they had a little bit of a spike when they hired the new CEO, but they're starting to fall again. And if you look at the last 5 years, after the crash and everything, you can see their stock isn't really sitting at one set point. It's up, it's down, it's all over the place. But the one thing that I wanted to focus on specifically was, let's pull up again, their dividends. That's what matters to me. I do not care about how their stock is doing when it comes to day to day. All I care about is are they paying their dividends and are they either raising or keeping them steady? And if you look at their dividends over the last 5 years, or actually ever since the crash, the last 5 years you see, look, it's been constant, it's gone up. There's been no dropping as the market has bounced around with Wells Fargo. Yes, there's the crash right there. You see a drastic drop-off of nearly 30 cents, which is a very large drop-off for anyone paying dividends. But since then, it's been a very steady incline. One small dip here, but again, turned it around, and has been constant and growing ever since. And to me, that's all that really matters. I care about a consistent yield or a consistent dividend that I'm going to get paid out, and they are right now running at a 4.29 dividend yield. The stock is down to 47.57 at the time of this video. It is the 25th at around 8:30. So to me, this is a stock that I really am interested in. I'm still going to watch it for the next few days. I want to clean up the M1 Finance portfolio, get everything moved over correctly. The account's right now on pause. As I said, I'll go into more detail about that. But once it's been on pause, I am pretty much going to be buying a few shares, or at least putting this in my portfolio to allow the auto investing to pick up a few shares for me. And the reason I say this, not just from the article, not just Warren Buffett, I was looking around to see what other people thought of it. And one thing that I came across was on CNBC, There is a company, an investment company by the name of Morningstar. And Morningstar is essentially just somebody that you can work with, and they'll help you with your long-term investing. That's just who they are. Again, I've said this before, I don't tend to take one person's advice when it comes to a stock. I do my own research, and I recommend that for anybody watching this video. If you're simply taking somebody else's advice or somebody else's portfolio and using it, you are at a greater risk of losing money because you don't know much or anything, usually, about the companies you're investing in. You're just taking somebody's word and going with that decision. And you want to be able to understand what you're working with, what you have, what's in your account, so you can adjust as the market goes up and down and things fluctuate. But there was a specific clip I wanted to show you. And there's two parts of this clip, and I will explain how I feel about each part. Let me pull it up for you. It is CNBC discussing the hiring of Charles Scharf. And here, let me play it for you.
What's your take on this appointment?
Yeah, I think this is really a home run for Wells Fargo. I mean, honestly, we didn't expect them to pull something off of this magnitude. I mean, we were advising investors, you really have to be prepared for Alan Parker to keep the job, just, with how long it's taking and some issues around payouts, things like that. So, I mean, to get someone of this caliber with this kind of experience, this kind of reputation, I would say it's a home run for Wells.
Now, what you just saw, this was just a representative that works with Morningstar. He's one of their higher up from what I can research and see. And again, I'm not taking his word as gospel at all. He is similar on the same page as me when I think it's a very good hire. Now, for a lot of this video and the rest of it, people saying it's not a home run, it's more of a double, or it's a good hire. But one thing I really want to bring to everyone's attention, and this is why I do dividend investing, and this is why this stock interests me a lot. Here, right here, let me play it.
Out similar price to book to Bank of America at the moment, but relative to Wells' own history, it's quite a cheap valuation. Would you be a buyer here?
I would not be in a hurry to buy it. I think the bottom, assuming stable markets, has been put in, and it's got a nice, healthy dividend yield of 4%. But as both gentlemen have pointed out, it's going to be a long time, getting the ship turned around. I think one of the important things, and one of the big challenges for him, was he is an outsider. There clearly were cultural problems at the firm, it just wasn't a one-off or one bad apple, this sort of thing. So in addition to figuring out a new strategic plan and what businesses to be in and where they cut expenses, which is probably the easy part, figuring out growth and getting the culture to change. And that's going to probably be, a big change in personnel. So I think there's time. If you're a long-term, very long-term investor, it's probably, the risk-reward is probably pretty attractive here.
That statement right there is exactly what I mean. Now, as she said, there's a lot of work that has to be done, and he has to clean a lot of stuff up, and there's been a lot of problems recently. But with that being said, with the problems that have been recently, you notice one thing: the dividends through these problems have not been cut. If anything, they've actually gone up during these problems. And to me, that is why this stock is something that I'm really, really interested in getting. I'll be honest, I'm going to be getting, there's no question. And that's why, especially because of the long-term growth. Yes, right now, you're probably going to see the stock go down a little bit more, or maybe sit stagnant at this. But for Wells Fargo, this is a very cheap price, considering where they usually sit. You'll see, they did hit a $43 at one point. They're sitting at $47. But over the last few years, they usually are in the 40, around this time. I thought it was a little bit lower. But regardless, this is something that I think has phenomenal growth for the future, especially with the new CEO. And it's going to be something that I really, really am interested in doing. Now, one thing I did want to show that for anyone that doesn't know M1 Finance well and what to do, as I said before, and I'm going to go into more detail about, when you create an account, I recommend putting pies. It's a lot easier, in my opinion, so you can determine what each sector has when it comes to percentage based. Ignore the 1%. It's something about transferring over again. I'll go over it. But the pies to me are easier because once you're within the pies, you can then adjust how that money is divvied up in each pie. So it's going to be Realty and SPHD are going to get 54.46, but that obviously breaks down to how the pie is itself. So I want to show how you make a pie because I've seen people struggling with this. So all you need to do to make a pie is at the top of the page, let me make sure it comes in clean. Click Research. Under Research, then you click My Pies. And everything I've created is in use currently. But if you want to create a new pie, you just click Create New Pie. Simple and easy. Now, all you do is literally just put in the ticker or the name of whatever companies you want to add to your pie. You click add to basket, and let's just go back to stocks, and I'll just show how it would work. Let's put in Apple and Google and Facebook. Didn't mean to click that, I click checkbox. And whoever else I want to add. You get the process. Then you simply click add. And then it'll create the pie for you. You click edit the pie, rename it to whatever you want. I'm just going to leave, I'm going to put it as test because obviously these do not go together. I would never put this in one sector. I would leave Wells Fargo in just a banking or finance sector. And obviously Facebook, Apple, things like that. Plus Facebook doesn't pay dividends, so that's not something I want anyways. It's just meant as strictly an example. And then you would click save. And then go back to research, my pies. And now all you need to do is just click add to portfolio. And what will happen is it'll go back to portfolio. It'll insert just like you would with any other stock, and you change the allocation for the stocks, how much you want to be put towards it, your target. And then inside you just divvy up how much you want of that target to go to each stock. It's very simple. I think it's cleaner. It looks a lot nicer. It's easier to manage, especially with just how the stock market is and how volatile it can be. And you don't know what the future is coming, so it'd be a lot easier to control an entire sector and adjust their target markets than to do one at a time, especially because my goal is to try to get around 20 to 25 stocks total. And it would just be not just difficult, but just be a pain to continuously adjust all 25 and make sure that I was getting what I felt was best for each sector and each stock themselves. So to me, that's probably my biggest takeaway with M1 Finance is I would do the pies as soon as possible. Again, you'll have to contact them if you want to change it. I'll go into that in a later video. But the main purpose of this video was the Wells Fargo and how I talked about they've been going through a lot recently. And on the dividend side, it hasn't done anything to their company. It has been essentially exactly as you want as an investor. And the only real hiccup was during that bailout that they had to receive during the recession. But besides that, it's been an ever steady growing dividend, and it's something that I'm going to definitely add to my portfolio.